money, money, money.
A quick disclaimer, the information provided in this video is for educational and informational purposes only. It is not intended as financial, investment, or legal advice, and viewers should conduct their own research or consult with a qualified financial advisor before making any financial decisions.
Money. We all know it, and most of us have learned to love it. But as humans, we always want more of it. However, we can only work so hard before our limited time and energy constrains us. So how do we get money to do the work for us? This is known as investing. In the context of this video, investing is committing your money in order to earn a financial return, or in simple terms, spend money to make money, at least when it's done correctly. Let's look at the type of investments we can make. I will start with the safest investments, and risk will increase as we go down the list. Now, we have to keep in mind that inflation, so that's the amount that the prices of the things we buy go up every year, is around 2 to 2.5% on average in Canada. Starting with low risk, let's talk about a savings account. This is the easiest and safest place to put your money, but hardly an investment. A savings account should be primarily used for your emergency fund and to cover monthly expenses, but a savings account will only go so far with interest rates around 1%, sometimes less. For those who don't know, interest is the additional money that we gain as a percentage of the original investment. When inflation exceeds the interest we're earning, that means you're actually losing the value of your money over time. Even newly trending high interest savings accounts hardly get you past that number over the long run. Next, we have government bonds. You give the government money and they use it for whatever they want. In return, you get your investment back whenever the contract matures, plus interest paid every single year for that period. These investments are considered very low risk because they're government backed. However, current rates for the most common terms often fluctuate right around inflation. So again, you're saving your money, but you're not really growing it. Next is GICs. These investments are literally guaranteed, which means the risk is taken out of the investor's hands and that onus is transferred to the institution offering the certificate. These investments yield low returns and often less liquidity. More flexibility within contracts means usually less returns. Medium risk investments. Let's briefly discuss what it means to earn compound interest. This occurs when the interest is earned as a percentage of the investment plus interest earned on the initial value of the investment. So for example, if we were going to invest $20 at 5% per month, the next month we would have $21 and the growth would occur again at 5% on that 21 rather than the 20, which is what we would see in simple interest terms. Corporate bonds. These are loans to companies for company activities. In return, the company is obliged to return your investment plus any interest. However, if the company goes under, your money now sits behind a long and expensive legal battle to get it back. Next are blue chip stocks. What the heck is a stock anyways? Stocks are small pieces of ownership of a company that can increase and decrease in value over time. Volatility is how much an asset's price can go up or down. Purchasing the stocks of a large, historically stable company called a blue chip doesn't guarantee anything, but it typically decreases the volatility of your money. Next are dividend stocks. Now, dividends are payments made by companies to their investors when a profit is made, or a thank you to the contribution of their success. The more shares you own in a dividend-paying stock, the more thanks you get. Not every company pays these bonuses though, so look out for the ones that do. The S&P 500 is an index made up of America's top 500 stocks known for their consistency. If one company fails, it is immediately replaced by the next contender. Instead of buying a piece of one pie, we are buying many pieces of a larger pie. High-risk investments. Let's define risk tolerance a little bit further before we get into these riskier options. The more risk you incur, the more growth you could receive, but more growth potential can flip to something truly torrential and cause your savings to go right down the drain. Cryptocurrency. This one speaks for itself. Unreliable, unpredictable, and prone to rug pulls. Crypto is unregulated and tough to get right. Pull it off though, and you might see some explosive growth. Just remember, crypto has a high risk, high reward relationship, so only use it if you can afford to lose. Speculative stocks. Stocks that are extremely volatile with no sustainable model. This type of stock is known to never pay out. However, the chance of winning big keeps them very desirable. So how should you start? Budgeting is usually the first way to begin. The 50-20-30 budget lays out a simple to follow budgeting technique that will get you started. 50% should go towards your needs, 20% should go into savings, and 30% should go towards wants, which in this case will classify as investing money. The rule of thumb is to keep in mind to always have 6 months worth of bills available as emergency fund or for those unexpected expenses. So what's our final take? It is easy to get sucked into the mantra of investments, especially with influencers and investment gurus blowing up all over the internet. But in the end, it's important to keep in mind your own risk level and what amount of money you feel comfortable investing.